Hey, inflation numbers are out, CPI, PPI, all of that good stuff. Job reports. What does this mean? This and more in your September market update. Hi, I'm your host, Singh.
And I'm your host, David Moroka.
We're going to get right into it. So, David, there's a lot of things happening, and we're only 11 days in.
Okay.
Before we get started, we wanted to, in 2001, 9/11, today's the anniversary of that. Our thoughts and prayers to all of the family members and anybody who lost loved ones on that tragic day. I can't believe it's been this long.
Yeah.
Do you remember what you were doing when that happened?
Yeah, I remember. I was just starting out with a travel company, online travel company.
Really?
Yeah, and showed up to work. People were buzzing. Phones were going crazy. And went to the break room, like, what happened? Because I had an afternoon shift. And they're like, the Twin Towers exploded. I'm like, what is going on? So that's crazy.
Yeah, I remember, Matt. I mean, I remember literally being. I was working for a credit card company, and I was going to college, and everybody went into the break room. I'm talking about everybody on the whole floor. It was like 100 some people gathering, watching the two TVs as the second plane hit, and everybody. People are crying. People are like, strangers are hugging one another, and the rest is history. Our lives changed forever. Yeah. So again, on today on 9/11 marks the history of the terrible tragedy that happened to our country, and we just wanted to send our thoughts and prayers to anybody who was affected by that. With that being said, David, it's 11 days in. The CPI numbers and the PPI numbers came out. I just gave a lecture to both David and Matt about CPI and PPI. These are statistics that people should know about. If you're in this country, I don't care if you're 15, 25, 35, 75, you should know these numbers. It makes me upset when people don't, because our goal is to promote financial literacy. So when someone doesn't know what CPI stands for, Matt, do you know what CPI stands for? Consumer Price Index, and PPI is the Producer's Price Index. And a quick shortcut for everybody that's watching to really understand what that is: a Producer's Price Index is what somebody sells a good for on the wholesale side. So, hey, how much things are costing for those that are making these goods, selling these goods. The Consumer Price Index is for consumers. It's anything that, we're measuring inflation, how things are rising for things that we buy day to day. Anyways, these reports come out once a month, and the PPI came out yesterday. The CPI came out today, and what was expected to happen was we were supposed to see a 0.3% increase to even a higher increase. It was supposed to be expected to go much higher than where it was at. It came in at 2.9%. Before everybody kind of zones out and says, "Hey, well, is that good? Is that bad?" Just a few short years ago, we were at 9.1% inflation. So these are high numbers. So the Fed's goal has always been to keep that number down below 2%. Have they been successful? The statistics show us yes, but it doesn't feel like that at anywhere. Like it feels like the wallet is burning a hole through it as soon as payroll comes in. But again, statistically, it's showing that we're at 2.9%, which is a large step down from where we were. And this is always decent news to hear. A number that comes out weekly is your jobless claims. So ongoing jobless claims reports. There's two job reports that we pay attention to, David, Matt. The first report is your initial jobless claims, and the second one is ongoing jobless claims reports. So initial is when someone is losing, like how many folks in the U.S. have reported that they're initially filing that they've lost their job. And this allows us from afar to be able to see real close, magnifying lens on, hey, are people losing their jobs? Is the job market getting wrecked? What's going on? If people are losing their jobs, that typically affects affordability. That typically affects the amount of goods and purchases that are being made. Transactions start to stall, things like that. But what happens, what number we watch even closer than that are ongoing claims. Do you know why we would look at that? What would you guess why we look at that?
Why we look at ongoing claims is because we're seeing if people are staying on unemployment long term or if they're just looking to get a job right away.
Exactly. So when we're looking at folks that are continuing to stay on unemployment, that's showing that there's not a quick enough rebound, and folks are still staying, without a job. Those numbers are actually short up. So what that means is folks aren't continuing to have ongoing claims happening. That's actually really good news. So yes, initial jobless claims are going up, but the ongoing job claims that are coming out are saying, hey, they're going quickly back to another position or another job. So that is mixed feelings, because it could be, hey, somebody left their job or got it quickly. Can you imagine back in the 2008 era where folks would lose their job and it would take them 6 months, a year and a half to land back on their feet? They might even have to. They were at that time. Do you remember, Dave? They were even going into different sectors.
Yeah, they were just picking up any type of job. They were working in some type of six-figure corporate job, and now they're working at a grocery store because they're just trying to get whatever they can.
So we're not seeing that today. With that being said, the last thing that I wanted to talk about was how this impacts mortgage interest rates. We started this year with interest rates for someone with a perfect credit score being in the low 7s, upper 6s. Now, for somebody with a perfect situation, I'll put the situation down below in a disclosure in our body of this video. They're in the upper 4s, low 5s. Rates have trended really low, and a lot of folks are not talking about this. And I think this is a perfect segue to kind of talk to you about it. David, what are you seeing in the real estate market nationally, and then what are you seeing here locally?
So nationally, I mean, if you look at if you hear the news, it's like mortgage rates have dropped, home sales are steady, but locally, I'm seeing that buyers are just coming out of the woodwork. I mean, my phone is blowing up for people saying, "Hey, rates are low. Can I afford to buy? What's my payment? What's out there?" So they are really like calling me and really wanting to buy. And the good thing about it is that there's a lot of inventory right now, so they have their option.
Does that give you if I was removing my real estate hat and my investor hat and my mortgage hat, and I'm looking at more sellers coming on the market, I'm like, whoa, what's happening? Because usually sellers come on the market April through August to try to pick up gains. They try to, sell their house during a high selling season to maximize the value that they can get, so they can take the most money on the table and go do what it is they're going to do, retire or go downsize or upgrade, whatever it is. Now, I mean, we're in the mid-September moment. October is like a hop, skipping away. That leads us into Halloween, Thanksgiving, Christmas, holiday season. Historically, we haven't seen a lot of people selling during that time unless they're have-to sellers. They're really motivated by some sort of incident, life event that's happening, right? With sellers, with this amount of volume, a floodgate of sellers, do you feel like this is going to be the consistent pattern, or do you believe that it's going to be even more sellers to come?
I think there's going to be more sellers to come, honestly. People have to sell regardless of their situation. I mean, anything can happen in their life situation. Things can change. So that's kind of what we're seeing right now, is that people have to sell. And that's why it's weird that we're seeing this uptick in buyer activity and sales and pendings in September, when this is traditionally the start of the slowdown cycle.
Okay, so I'm going to ask you some hard questions. The two hard questions I'm going to ask, which they want to know, right, is, let's start with the buyer. If somebody is thinking about buying right now, a fun fact for you, there's a lot of annual lease renewals that take place in September. Why is that? Well, hey, if you're looking out for a home and you couldn't get in August, well, you still need to get into a home in an address so you can register your kids or whatever life has you. You got to get in there. So typically those that have missed out, or those that just couldn't get qualified or weren't ready, they usually come in and they renew their lease in September. We see big renewals like that, With that being said, what would you do if you were a buyer watching this who maybe just recently renewed their lease but is tempted now because rates have fallen a little bit and affordability is getting back to normal?
Honestly, I would get with a mortgage professional like yourself and really look at the numbers and say, rates are really low right now. Using a strategy of buying down the rate, what could the payment be compared to what they're paying in rent, because rent continues to go up. But now with a little bit more affordability, like for example, on a $450,000 house, if they're an FHA buyer, really look at the numbers. I think they're pretty close.
I think you and I just calculated it's really hard to give you guys an exact scenario without doing a lot of minutia of disclaimer. So here's a quick disclaimer that will keep us compliant. If you have above a 640 credit score, if you have 3.5% down, if you have a debt to income ratio below 45%, if you're purchasing an owner occupied primary residence, meaning that's where you're going to be laying your head at night, you're going to be living there, getting your mail there, you're not renting it out. If it's a single family residence, and if it's in California, and if it's in Sacramento and Placer County, do you see how this goes on? If you've been at your job for 2 years, if you have an approved eligible findings and that loan can be made, and on a 30-day rate lock. With all of that at a 96.5% max loan to value, with all of that, you're looking at probably a 4.99 to 5.125% FHA rate right now. That's a killer deal. When we do that and we use let's say 1970s or 1980s built home, I'm not using that to be cheap on this show today. I'm doing that because 75% of homes are built before 2000. That are on the market right now. So 3 out of 4 homes are built before 2000. When we buy one of those homes, typically, if they're not in the Melrose, the property tax is going to be 1.125%. If you've not had a claim, your insurance is typically going to be about $950 a year on that home. And that home's going to look like what? 3.2, 1,200 square feet, 1,400 square feet, decent backyard, ranchette, That payment was like $2,738 when we calculated it a few minutes ago. What would something like that rent for?
Rent for about $2,500 a month.
Wow. Yeah. So you're seeing rents catch up to mortgage payments catch up to rents for certain price points.
Exactly. Yes.
Touch on that.
Yeah. So if you're renting a house, regardless of the age, you're tired of renting and you want to get something that's your own. Yeah, you want to look at your starter home, which is going to be those 1970s, 1980 home, around the $400,000 price range. Yeah, you may need a little touch up here and there, but yeah, it's when you look at the numbers, they're so close that for a couple $100 more, it's your own home. You can do what you like with it, and you don't have to worry about your landlord saying
you're paying towards principal.
Yeah, but your landlord saying, "Hey, I got to sell the house," or "I'm sorry, but I got to increase the rent."
If you had to guess, David, Matt, I'll throw this out at you as well. If you had to guess in Sacramento County, the county as a whole, from the period of 2019 to 2021, I'm not trying to put them on the spot for statistical numbers, which is what we do really. If you had to guess, how many homes would you say were in Sacramento that are 3-bedroom, 2-bath, that were not complete guts or fixers? Under 400,000 during that era.
Under 400,000.
2019 all the way to 2021.
Under 400?
Under $400,000. 400 or less. I'll even give that to you.
Sacramento County.
City or county?
No, Sacramento County. Tell me.
Sacramento County, you're probably looking at maybe 1,500, 2,000 homes.
No. Under $400,000 for sale between 2020 and 2021.
2020 and 2021?
Yeah, highest peak years.
Oh, man.
Maybe, 5?
Yeah, maybe.
Maybe 5,
10,
right?
Yeah, 5, maybe 10.
Anybody want to take a wild guess as of today? How many are 3-bedroom, 2-bathroom homes under 400,000 right now at this very moment?
Right now?
Because I have Redfin pulled up. I wasn't being rude away from you guys on my phone. I just wanted to. Anybody want to guess?
It's probably about 500, 600.
There's 89 homes.
89 homes.
That's still a lot of opportunity.
Yeah, okay, I was talking about the entire Sacramento region.
Yeah. If I go into not even the region, just the county. Yeah. If I go into San Joaquin County, there's double that. When I go into Stanislaus County, like Modesto, those areas, there's triple that. This is the first time I've seen it's kind of a perfect storm. Touch on it. Like you got this price point of 400 or less. At that price point, the rent and the mortgage is pretty comparable. This is your starter buyer, starter home, right? And we now have this rise of inventory, and it's only 11 days into September. It's not even October, November yet.
Yeah.
Wait for December.
Wait for December,
like,
right?
If this trend happens, by December, you're going to get a steal, and you're going to end up, your mortgage payment is going to be less than what your rent would be.
Well, we're factual on the show, so a steal is, interpreted to the person buying it. But I think that I think you're right. I think this is a perfect storm. You still got interest rates that way. Now I'm going to talk to you about something a little different, right? The strategy that we saw this whole year with home builders. Now, really think about that. Like, you're getting your intel from Sonny and David. I got 23 years experience. How much you got?
20 years.
20 years. So 43 years combined experience, selling real estate in the weeds, in fresh pipeline of loans, doing it actively daily, okay? Investing daily, okay? With that being said, I don't know, man. I just think that, the builders have more money than us. They're publicly traded. They have intel that we don't have intel on. And guess what they're still doing? They pivoted. A lot of the builders I'm looking at, Lennar, KB Homes, they pivoted away from a 3-2-1 buy down, which a 3-2-1 buy down, if you're not aware, is whatever your fixed rate is, subtract 3% from that for the year one, 2% the second year, and 1% the third year. So I'll give you an example. If rates in January were 7%, then if you did a 3-2-1 buy down, your first year you'd have a 4%. Your second year, you'd have a 5%. Your third year, you'd have a 6%. After the third year was completed, your rate would be at 7% the rest of the time. It was a really cool way to be able to get a cheaper rate in anticipation of rates dropping. A lot of folks did this over the last 3 years. 2022 is when we started seeing rates fluctuate, right? Now here we are, and builders are like, no, we're doing a 2-1 buy down because they're already seeing that rates are dropping, right? This is a great time to revisit a 3-2-1 buy down. Imagine being an FHA buyer and under the disclaimered scenario that I just told you, and it's 4.99. Are you kidding me? Now you're at 1.99 for the first year, 2.99 for the second year, 3.99 for the third year, and 4.99 for the rest of it. And if rates dip again, you can refinance. That's the crazy part. I love the FHA loan because it offers an FHA streamline. So down the road, if your value goes down and you're not able to, get that appraisal to come in to refinance, FHA Streamline says as long as you're going FHA to FHA, no income requirement, no asset requirement, no appraisal requirement. This helps a lot of people.
It does. It does.
Yeah.
And actually, I wanted to touch on something that we discussed a little bit earlier. It's like, yeah, this is great news for buyers, but for sellers, what are they doing? Like, should they wait? Should they not? This is... if you hear this news as a seller, you're thinking, what am I going to do? So, those people that have like 2% interest rate, 3% interest rate when they refinanced in 2021, 2022, what are you seeing on your side, on the lending side? Like,
hey man, this is what I'm seeing. Yeah. I got a 1969 Camaro at the house. It's full original numbers. I'm never letting it go. That people are treating their 2%, 3%, 1% interest rate like platinum, not even gold, platinum. But it sucks because, again, we're trying to promote financial literacy. And so a lot of folks look at their mortgage, which is their largest debt, and they're like, hey, I got a 1%. I'm never letting this football go. But then their debt is grown to $80,000, $90,000. They're living off credit cards. They're living off of really think about this, David. Your car breaks down, your transmission dies out. Those skilled trades of yesteryears, right? Mm-hmm. They're not around. I don't see them a lot. The skilled trade industry is really, before you'd be like, hey, I want my kid to grow up to be a doctor or engineer. It's like, you know what? I hope my kid does become an electrician because they make bank. I hope my kid does own a framing company one day. I hope my kid works as a lineman for PG&E. They make it more than doctors at Kaiser, And I'm not saying that to bash on doctors. I'm saying we've forgotten so much about what the trades are that no one's really going into it. Everyone's looking for a quick buck. That's what it feels like, So now if your tranny blows or your engine blows, the ability to find somebody who's not going to do that for an arm and a leg, it's not there. So you're going to now take out an auto loan. And guess what rose by 1%, a full 1% on today's CPI reports just released 3 hours ago? Used vehicles. Used vehicles are 1% high. That's a lot. Things are getting more expensive. So now you're going and getting a used car rate. That's what, in the 8 or upwards in the 8 to 10% rate right now. Then you're going and buying a used car because you need to travel to work. because we're back to work. Lockdown's over, right? When that happens, you're taking out an auto loan. Your credit is weighted down. Your credit scores are going down. I've seen more mid 600 credit scores. I've seen more people with 2% rates with 60 to 80 grand in debt because of life. And their credit score went from a 740 to mid 600s because it's weighted down for carried balances than I ever have in 23 years. What do you do with that?
That's when they, honestly, I'd ask you, is like, if they came to you and said, Sonny, I'm in debt, like up to my ears. I have a 2% interest rate. I have quite a bit of equity. Can I refinance? Should I refinance? What do I do?
No. Yeah. No. They barely could afford the mortgage at 2-3%. Mm-hmm. I'm volleying them back like a volleyball to somebody I trust. And I'm going, you know what? Maybe you should talk to David. Maybe you should talk to your realtor. Mm-hmm. Maybe it's time to sell. Oh, I don't want to sell. Flashbacks of their child's bedroom and the paint that they did and the barbecue they hosted and the fun times they've had at that home and happy birthday and all that stuff, right? And they're like, no, enough. I'll die before I let go of my home. And I'm like, well, you're going to be in bankruptcy court soon. And the income you got right now, because you're barely holding it together, is still high enough where you can't file bankruptcy successfully for a straight liquidation Chapter 7. It's sad. That's what I'm seeing. I'm not giving anybody any legal advice. That's a disclaimer. Everybody's, looking for, but I'm telling you, man, that's the crappiest thing that I'm seeing right now. Yeah. It's real world is hitting real life. And folks almost have this thought process, David, of like, oh, rates will drop again. And then at that point, I'll refi. When they get to 3.5, I'll refi again. I'll pay off all my debt. No, you can't. When you do that, what if the valuation's not there? What if your loan to value is in a poor position? What if now your house that was 450 is worth 400, so 50 grand gone? Take the money off the table. Go rent for a little bit, take a breather, recollect your thoughts, buy a home later.
Yeah, that's actually happened to me right now. I have some clients that came to me and said, you know what, I have $150,000 in debt. I try to get a HELOC, equity line, but I can't pull out enough to cover my debts. So it's not wise financially to do that. It's like, what do I do? But I have a 2% interest rate. And had to sit down and talk to him and say, well, look at the whole picture. Yeah, you give up this house. Let's sell the house, take all the equity out, pay off your debts, and see if we can get you a house that, with the rates low that they are now, see if we can buy you another house that's comparable, and your payment's going to be pretty much the same, maybe a little bit more, but then you won't have all that debt.
Sure.
And, sure enough, that's what they did. They decided, yeah, our financial future is way better than kind of dying on this hill of I have this 2% interest rate and I don't want to let it go. So, that's what they're doing. We're about to close in a couple of weeks and they're going to be debt free.
Wow.
And then moving into a house where the payment, it's about $400 more than what they're paying now. But
on their mortgage.
Yeah, on their mortgage.
But on their overall, they're saving
they're saving, thousands because they don't have that $150K in debt.
Credit cards are not tax deductible.
No, yeah.
Mortgages are. Well, hey, in closing, because we kind of ran a little longer on this one, David, if you had to speak to anybody out there, who would it be and what would you say?
Who would it be? It would be the sellers. Again, that 2 or 3% interest rate. Really look at your financial situation and see if this is the best time for you to sell, because you're seeing buyers out there. So your house will sell if it's priced right, but don't hold on to that 2 or 3% interest rate just because you feel you're never going to get this again, because you'll end up losing the house in the long run.
You know what? If I had a message for anybody, that was a beautiful message, by the way. Very strategic. If I had a message for anybody, it'd be to the professionals out there. If you're a real estate agent watching this, if you're a CPA watching this, if you're a financial advisor watching this, if you're just a friend that's the leader in your circle, you know who I'm talking to. Like, you know who you are if you are. You're the guy or the gal that's the glue in your circle, your tribe, okay? You need to do better. You can't just do the basics. You got to guide people. This can't be transactional anymore. If you're a CPA, I'd love to see an intake form where you're asking above and beyond questions about, what their debts look like, what their other finances look like, if they're cash strapped, if they're cash flowing. Put them in a good position. You don't have to counsel them, but you could say, hey, you know what? Your income's looking great. You could use a Schedule E deduction. You know, it might be a good time for you to pick up a rental. You're helping people grow. And then make a referral program out of that or something. You know, I don't know. I'm just throwing it out there. This is not to get transactions out of you. It's for you to do better. If you see somebody on the other hand doing poor, like they're cash strapped, they need the deduction, they're going like, can we get a refund? If they're doing that to you, like ask the deeper question. Have a systematized process for that. If you're a real estate agent, you see what David's doing. Carbon copy that, improve upon it. Right? Have a listing checklist and a process. Have a systematized process where you're like, hey, I need to be a real bigger thinker for my client. My client's going, oh, no. Body language is like this. I got a 2% interest rate. I'm not going anywhere. But their debt's racked up like this. It's not a good look. If their equity drops by 10%, they what are they going to do now? They can't even sell to get out of the debt. They're going to be in bankruptcy court and possibly facing a foreclosure. You know what I mean? We need to do better. We need to do better as society. We need to do better as professionals. That's the only message I have for today. Thanks for tuning in.